Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, June 2nd, 2017. So it was a short but very eventful week as pretty much all major stock United States indices went to fresh all-time highs. The rally is broad and most sectors also put in new all-time highs, and of course two exceptions are financial and energy. The junk bonds did confirm fresh new highs. However, there is strength in treasuries and bonds and investment grade bonds of all sorts, so we'll look at that in a little more detail. The dollar is under pressure, and we will see if maybe euro and the pound has turned bullish, and yen is continuing to gain versus the dollar. Of course, gold is loving a weaker dollar and is taking advantage of it, and it's gained for the third week straight. Gold miners are slightly behind. And oil had another nasty week with a 4% loss. I think the bigger trend is down for oil, and we'll look at major oil-related ETF as XLE is approaching 52-week lows, and XES and XOP are already there. While natural gas gapped down, ran almost 10%, but I think this could be a buying opportunity. Okay, S&P 500 ETF SPY, very powerful V-shaped reversal here from May 17th drop, and then basically immediately we got buyers stepped in and pushed the prices higher, broke to fresh all-time highs here last week, and we continued this week, and we finished very strongly. So this is showing very strong and resilient market, and basically breakouts to fresh all-time highs are obviously bullish. Now, you'll get many answers if you ask a question, is this market overbought? Um, it's probably overbought. Probably we're overdue for a correction. Statistically speaking, I think we're overdue for at least a 5% pullback. And I'm thinking we're going to get it sometime soon, especially considering that June 14th is FOMC, Federal Reserve meeting, and they're going to make an announcement about the interest rate. So that usually provides some sort of an excuse, potential excuse for bears to step in. Advanced decline line did hit fresh all-time highs. Advanced decline volume did not yet. Does that mean that we're going to have an imminent correction? Not necessarily. I use advanced decline lines as a secondary indicator. I don't necessarily, if I see a divergence, that does not mean that I'm going to act on it. It just means that I'm getting a bias, I suppose. So let's say that we're getting some strong divergences. In fact, I'll show you soon what I mean. When we get to energy, I'll show you what I mean. We had pretty clear bearish divergences there. So there I basically said that I will avoid going long on energy, and I was proven to be correct ultimately. But market breadth is I think a good indicator if you know how to use it, and I think one of the ways to use it is to confirm or deny your general theory, whether or not the market is in a bull or a bear phase. And clearly to me, the market is in a bull phase. S&P 500 here again, just a couple more market breadth indicators. The bullish percent index and the percentage of stocks above 200. Again, small divergence here, but notice that even though we have a small divergence and it looks like a small bearish divergence, we're breaking to fresh highs. So this means that less stocks are participating, but nevertheless, we don't trade the indicator, we trade the index, we trade then the price of the index. So even though we're seeing maybe slightly less participation based on these two measures, again, that doesn't mean that we're going to have an imminent correction or the market has flipped bearish. In absolute terms, these numbers are very good and very strong. On the weekly time frame, this is S&P 500. Notice that we had two triangle consolidations here, both resolved to the upside, so it was a very good and clear breakouts. Additionally, it looks like we are now seeing a confirmed breakout above resistance point 1, because it looks like we closed 2 weeks in a row above the resistance point 1. So I think we could say that we have safely broken out above it. Let me look at QQQ, and I think QQQ actually broke above resistance point 2. So yeah, it's very steep, very strong uptrend, and notice that there is a gap here and we haven't even filled it yet. So this looks like a very strong index, strong buying pressure is present. Definitely overdue for a pause, but again, we don't know where that pause will occur. A good place for it to occur would be in a few weeks on June 14th, when the Federal Reserve meets. So QQQ on a daily time frame. Here we have an oscillator, which is a breadth oscillator. You can substitute pretty much any oscillator like stochastic or MACD, and you will pretty much get similar readings. Yes, we're definitely in an overbought territory, but I did a little bit of looking back, and I looked at this particular indicator, breadth momentum oscillator. High readings in and of themselves do not necessarily mean that we're going to have a pullback. In fact, the opposite is sometimes true. If we have very high readings, that means the momentum is quite strong, and actually we could continue to experience further gains. For QQQ, I absolutely have no problems with this particular chart. Notice the advanced decline lines are also at fresh all-time highs. Here is a QQQ, just showing a couple more indicators here. Here is RSI. Notice that it has been consistently overbought. There is a little bit of a divergence now. Again, that doesn't mean anything. We could see, we had divergence here in August. Notice that we became overbought here in August, and then the indicator kind of actually went lower. But in general, we could see a fresh all-time highs being made. So even though there was a momentum divergence, that does not mean that the longer-term trend has changed. Again, a little bit of a divergence here in bullish percent index and percentage of stocks above 200. But in absolute terms, these are excellent numbers. If this was maybe like 30 or like 20, I would get worried. But we're in the 80s and 70s here. So in absolute terms, I think these are really good numbers. Of course, strength in the QQQ is being powered by semiconductors. Very strong move, SMH at fresh all-time highs. And here's biotech, also over the couple of last 3 days, actually had a very strong surge here, and there's quite a bit of biotech stocks in QQQ. So far I see no issues with any of the just above mentioned charts, except for I probably wouldn't be chasing them up here. I would probably want to buy and a slight pullback. And we are doing this at MasterChartsTrading.com. Here is a New York Stock Exchange Composite Index. There are something like 2,800 stocks in this index, and it just put in fresh all-time highs. So I think we can safely assume that the rally is quite broad. A little bit of a divergence here again, but the divergence is in the volume, and how much should we worry about it is, again, difficult to say. The actual advanced decline line did put in fresh high here. And again, in absolute terms, the percent of stocks above the 200 and the bullish percent index is actually pretty good. I wouldn't worry about it until we get to like 20s or 30s. So to summarize, I think we're having a fresh breakout to all-time highs, and this could be like a very really important breakout because we could continue moving higher. I don't think we have put in a even an intermediate top yet. The Dow Jones Industrial Average finally breaking out to fresh highs, and this is without the dividends. With dividends, it already broke out a few days ago, but here without the dividends, INDU fresh all-time highs. Advanced decline line is confirming. Volume is lagging slightly, but again, I'm not sure how much to worry about that. And now let's get into some of the sector funds. Consumer discretionary, the most economically sensitive fund I think out there. XLY, fresh all-time highs. Strength in this fund in this sector is very important to the general market. XLI, industrial sector, fresh all-time highs and confirmation from the advanced decline lines. Very important sector to the general market. Of course, QQQ or XLK, same thing. Even healthcare is breaking to fresh all-time highs. And there's a lot of biotech stocks here, so I'm sure that it is helping XLV. XLP, the consumer staples. This one was the first to break the fresh all-time highs, and that would worried me a little bit at first because this is a defensive sector, but now looks like every other sector is catching up as well. So this is looking very broad. Participation is quite broad. Utilities also broke out together with XLP a few days ago, and that's what worried me. But I think right now it looks like we're moving, all the other sectors are moving together higher. Again, I don't think we have put in even an intermediate top yet for the general market. Here we get into a little bit of laggards and IYR real estate. This is not 52-week, this is not all-time highs, but nevertheless, I still think this is a bullish chart. And a few weeks ago, I mentioned this hammer-like candlestick, and looks like we have bottomed and then moved higher. And at MasterCharts Trading, we do trade this as well. So hopefully, my subscribers did take some positions in this. I also have a real estate fund, but a smaller one. It's KBWY. I just bought it recently for a swing higher. It's just a small cap REIT portfolio that we do trade at MasterCharts Trading as well. So here is some pronounced weakness in retail section, retail sector rather. Retail is an industry group, and it's part of a consumer discretionary sector. And notice that consumer discretionary XLY is actually moving to fresh all-time highs, despite the weakness in the retail sector. So average stock. This is mostly like almost like a equal weight retail sector. These are almost 52-week lows. The 52-week lows are down below here. So retail really needs to get its act together quickly. Otherwise, 52-week lows. Let's say, let me show you a stock. What happens to stocks that hit 52-week lows? So, for example, here is SKT, and I wanted to show what happens to it once it hits 52-week lows. So notice this is a weekly chart. So notice here in March or February rather, new 52-week lows were put in. We had a small bounce, and then it just unraveled to fresh 52-week lows. So in other words, stocks that hit 52-week highs usually continue hitting 52-week highs, and vice versa. Stocks that hit 52-week lows usually continue hitting 52-week lows until something changes. So I'm really hoping XRT will stop soon. Here's the most worrisome part of the market, and this is financials. Now, this is about, it's not the biggest sector. Biggest sector right now is technology, but still, this is an important sector for the general market. And here we have a bullish chart because these are multi-year highs. But here what worries me is this breakdown in market breadth. Notice that back here in April, XLF did not yet put in a low. The lows were back here in the beginning of the year, but market breadth actually showed a pronounced tendency to move lower. So that's what worries, is worrying me about this particular sector. And notice that, obviously we're not breaking to fresh highs. We're nowhere near multi-year highs even. So this is definitely underperformance, and I think this has to do with strength in bonds. And when we get to bonds, I'll show you that bonds actually bottomed out here in March and started moving higher. And there's a lot of banks here, so obviously the banks are under pressure due to interest rates moving lower because they have a harder time making money. In fact, here is KBE, the bank index, and on this one I just wanted to show that I don't think we have bottomed out yet again, and I keep showing the same chart, and notice that we're just having a hard time. There is just no good looking bullish candle. Here is XLF on a weekly time frame. Last week I thought this was, I didn't think that this was a strong enough candle for me to say that okay, we definitely have bottomed. But and if you listen to my previous video from last week, I said the same thing. I don't think we have bottomed yet here, and notice that we are still moving lower, but maybe this is already like a hammer candlestick and maybe we'll eventually stop falling. And finally I wanted to show KRE, a very similar pattern to XLF. These are small cap regional banks with a similar pattern, and again I don't think we have stopped falling just yet. Notice the relatively weak candles and a fresh low here actually in the index. Alright, let's move on to bonds. This is junk bonds. So here I wanted to show that junk bonds, as I keep previously mentioning, that they correlate highly to the general market, so I kind of group junk bonds together with the stocks, and notice that they have put in fresh all-time highs together with the junk bonds. And actually last week I pointed out that this resilience here in the junk bond market was kind of like a tell that most likely the bears have failed on May 17th here, or rather May 17th here. Notice that you can't even see this on a weekly time frame. So junk bonds, fresh all-time highs. This is good for the stock market. How long this will continue is anybody's guess. Eventually we'll see some sort of a topping pattern, and then we'll say, oh, okay, it looks like we may have a problem in our hand, like for example here in 2015-16. Investment grade bonds and especially treasuries have had a great week. TLT, lots of buying pressure present. Notice there were gaps here, bullish gaps here, and on Friday we broke out to 2017 highs above April highs here, and now we're attempting to fill this unfilled gap from November gap down. So there is strength in the bond market, and this is what is worrying me about the stocks, is that why would investors be switching to very safe treasuries and long-term treasuries and relatively safe corporate bonds when stock market is doing so great? And this is a question that will most likely be answered soon, especially with Federal Reserve meeting coming up shortly. Here's TLT on the weekly time frame. Here what I want to point out is we had resistance here from April highs, and notice that looks like we have broken out above that resistance. Additionally, notice that we have broken out above the pivot point, the yearly pivot point. So this is definitely an important sign for the bond market. And at MasterChartsTrading.com we do trade TLT, and I actually have a position open that I opened relatively recently. So I'll show you once it's done. I'll show the position once it's closed. So here's a relative chart. We have SPY divided by TLT, and this just shows that here from November, obviously stocks were outperforming bonds, but here from March on, notice that stocks, even though they were gaining, TLT was gaining stronger, and notice that TLT is actually now outperforming bonds, or outperforming stocks. So again, why is this happening, and should we worry about it? This is definitely an important development, and when stocks are outperforming, that means the risk is on, and all of a sudden now bonds are outperforming. That means possibly we're going to have a more difficult period ahead of us. That's my read of the situation right now. Here's the just weekly time frame for S&P 500. This is going back 2 years, and here below I have performance for S&P and for TLT starting 2 years back. So they both gained, both bonds and stocks gained some over the previous 2 years. Bonds obviously gained a little bit less, but now it looks like again we are starting bonds really are perking up, and again I wonder what this means. Why are we having bonds outperform when stocks are hitting fresh all-time highs, and the risk should be on, not off. Here's the TYX, or 30-year Treasury bond yield. So this is basically opposite of TLT. When bonds move up, the yield moves down. And notice that this is a new low for the 2017, even though these were 52-week highs. So I wonder if this is maybe just a corrective period, and then eventually will move higher. In other words, bonds will lose value, or it is something the opposite. Long term, this is very long term. This is a monthly chart going back 40 years for TYX. Notice that the bond rate has been steadily dropping over the past 4 decades. And honestly, I don't think we're done yet. So here's what I wanted to show. Let's just zoom in to the previous 2 years. And I don't see a breakout yet. And the breakout would be if we broke out above, well, let's say 32, so 3.2%, 5% here. And so far I just don't see it yet. I mean, this is a new low here from June of last year, and we attempted to go higher. We attempted to break out above June 2015 high, but I don't think we're there yet. Now, if we broke out and closed above it, like at around, let's say we got the yield to around 3.3%, then definitely I would say we have reversed, but we have not yet done so. So I would not yet put a nail in the coffin for the bond bull market. AGG, this is diversified bonds. Again, lots of strength here, lots of gaps. Notice that we have a bullish cross here where 50-day moving average is going above the 200 and a fresh 2017 high. AGG is a diversified bond fund, broke out above previous resistance here, and now we're actually approaching all-time highs, and this is with dividends. So we're getting quite close to all-time highs, and this is clearly bullish in my book. Here's the LQD, which is investment grade corporate bonds. This one is very strong move here from March lows, just an enormous move really, for the bonds obviously, and then gaps here which are showing presence of buying pressure. Notice that we have filled the November gap down a long time ago here. And here's finally weekly time frame for LQD. Notice that we're very close to fresh all-time highs for LQD. So this is still a bullish chart to me, and I would not short it. Here's US dollar on the daily time frame. This is a dollar index. Notice we have put in a fresh 2017 low here. So we had a support break a couple of weeks ago, and now we're moving lower. Now, it's possible that we have indeed reversed from multi-year highs and are now in a bear market for dollar. I would not necessarily say that just yet, though. I mean, looks like we are going to be retesting November lows for the US dollar index. There's still a lot of room for the dollar to wiggle before a true bear market will start. The euro in particular has been acting quite strongly, and notice that there's this gap here, a rare gap for forex, for currency, a gap, and we really ran higher, and this is a fresh 2017 high here. Notice also a bullish cross. So it is possible that euro has indeed reversed. If euro has indeed reversed, then the dollar, because the dollar index is like 50% euro, and if euro is going to be moving higher, then the dollar index most likely will move lower. When we get to gold, this is important because gold absolutely loves cheaper dollar. So right now it's still a breakout question mark, but we're definitely approaching actually 52-week highs for the euro, and I wanted to show you what I mean because it's kind of hard to see sometimes. So I put on a 52-week channel, price channel. We're actually quite close to 52-week highs for the euro, and notice that we moved off the 52 multi-year lows for that matter, and just almost straight up moved to approaching 52-week highs. So this is an important and possibly a reversal point for euro. Maybe we'll finally see euro reverse and move higher from here. British pound also similar pattern, had I guess this was a breakout that I'm looking at now, and a bullish cross here, 50-day over 200-day. I mean, long term, this is still quite bearish to me. I mean, these are multi-year lows, 30-plus year lows, but maybe we have reversed. It's possible. I guess euro, the direction of euro will most likely define where dollar will go. The US dollar is losing ground against the Japanese yen as well. I thought here we are, moving higher. In other words, the Japanese yen is the dollar is getting stronger versus the Japanese yen, and it was true up to here, up to beginning of 2017. But then, since then, looks like we're been in a corrective pattern. It's still possible that this was maybe like a flag, and we could still get a breakout. Flag breakout and continue higher. But I think if euro and pound are going to be gaining, I don't see why it should be Japanese yen should be any different. So to summarize, I think dollar may have reversed, but I guess we will see it shortly, especially if we fail this November low test and continue lower. Okay, let's move on to gold. Gold has been behaving quite well, and it has been taking advantage of a weaker dollar. So here's US dollar. This is gold here in the upper part. I put US dollar here in the lower part, and notice the correlation is quite negative. So in other words, when the dollar is moving lower, gold is moving higher, which is a normal correlation. Here we had the golden cross a few weeks ago, and gold is moving higher still. So this is, confirming my bullish bias for gold, and we do trade gold and gold miners at MasterCharts Trading. In fact, I have a position open in GDX myself right now. So fourth week in a row of straight gains for gold, looking very good, especially if we break out above April highs here. I think we could easily re-challenge November highs and possibly 52-week highs as well. Now gold gained about a percentage point this week. Gold miners kind of have been lagging a little bit. In fact, gold miners lost a fraction here, but gold miners surged over the past few weeks. So I think either this is going to be a temporary underperformance for gold miners, or possibly we will have another back and forth. Maybe we'll retest May lows here. It's possible. On a daily time frame for gold miners, we have a bullish divergence. Now again, this bullish divergence is sort of like a nice extra. I wouldn't necessarily just act purely on the presence or absence of a divergence. You need to see price action confirming your theory. So notice that we have a lower peak here for gold miners, but we have a higher peak for underlying market breadth indicators for gold miners, advanced decline lines. In my opinion, this is great news, and hopefully we will move higher. Maybe this, we're kind of like we had an initial surge, and now we're just working off some of the overbought conditions, and eventually we'll break out and continue higher. I mean, this could be like a flag, or this is a fallen flag right there. And if we close above previous high here, 2367, we could easily re-challenge February and November highs, which is, I think, a strong resistance, and it would be an important test. But if we do clear it, I think we could easily go to 52-week highs. No, and some of the market breadth index indicators, my proprietary indicators here, we have been in a corrective pattern. So we had an initial surge. We actually put us into a bullish trigger here in May, and now we're basically in a corrective pattern. Here is the one of my indicators, the ITBM, intermediate term breadth momentum oscillator. Basically, we had a big surge, and now we're kind of trying to work off some of the overbought conditions. I think we're having a similar pattern to December-January pattern here. Where we had overbought conditions, they persisted, and stocks GDX actually moved higher. So it's possible we're going to have some along the same lines. Okay, here's oil in the daily time frame. Now, a few weeks ago, I pointed out this big drop here, and I said that most likely this is the failure already. So we had a well, okay, let's go back a little bit. We had an initial support break back in March of this year, rally, counter-trend rally, failure here at resistance, and the drop, another counter-trend rally, and failure at a lower high now than from April. Now looks like we are moving lower again. So I think oil is bearish simply because of there's just a glut of oil in the world, and no matter how many production cuts you implement, I'm not sure how much production cuts are going to be balanced out by the increases in production from the American producers, which can, I think, outproduce pretty much everybody in the world. Anyway, so oil is bearish, lost 4.3% for the week. I think we're headed for a retest of November lows and March and November lows at around $42-43. If we break those, then there is plenty of room to run to the downside. And here's what I wanted to show as an example of using market breadth to confirm or deny, deny your theory. We had 52-week highs here for XLE back in December of 2016. But these were not 52-week highs for XLE, advanced decline lines, and advanced decline volume lines. And then since then we just started moving lower and lower and lower, and then eventually we started breaking support for the advanced decline lines, and we started hitting fresh lows for the advanced decline lines here back in March. And even though, for example, here we had a bounce into March, April, advanced decline lines really didn't do much, and then we continued to move lower and lower and lower, and we had a bearish divergence where the advanced decline lines hit fresh lows, and then eventually index follows. So notice that we're now at 2017 lows for XLE. We're a little bit oversold, but I don't think we're extremely oversold because this is a bearish security. So it's normal for it to become oversold. Here's XLE on the weekly time frame. Notice that we are approaching 52-week lows. Here are those advanced decline lines again, and I wanted to show what I mean. Notice that we were hitting lows as early as March of this year before, obviously, the index hit lows. So the breadth is interesting to use, and I think it's helpful. To me, it's helpful. It's not helpful to everybody, obviously. Some people can just go pure price action. I like to look at the underlying strengths or weakness as well. Here's XCES, the gas and oil equipment servicers, fresh 52-week lows. XOP, the oil and gas exploration ETF, just put in another 52-week low here as well. So overall, I think oil related, are in a downtrend, and I think that we'll see fresh lows for XLE before we see some sort of a bottom in action that really hasn't even begun yet. Here's natural gas on a daily time frame. So from February here we had a big rally in natural gas prices, and looks like we topped out here at $3.43 or so, and now we're dropping. Now this could be thought of a support break, but I view it more as a possible opportunity to get long for a bounce. Now at MasterChartsTrading.com we do trade this as well in small quantities because this is a very volatile security, and additionally UNG doesn't track the underlying that well, and UNG consistently loses value versus the underlying. So I guess you could play it using the futures if you have a futures account, but not everybody obviously has a futures account. So for now I see a bullish security that is somewhat oversold. Now the million-dollar question, of course, is to find where it stops falling. And notice that we had a big surge here in November, a fresh 52-week high, and then a very deep pullback. And I was looking for a bottom basically, and eventually it was found, but again we don't know where this bottom will be put in. And additionally, it's possible that we're seeing like a head and shoulder. So like this is a left shoulder, and this is a head, and this is a possible right shoulder. And if we do get to around $2, what is it, 65 cents, $2.50, and we break that, then the head and shoulders would be complete, and we could move significantly lower. It has not happened yet, and it's possible that we'll just bottom out and continue higher. To me, a natural gas right now is bullish. Alright, if you like what you're hearing, please hit the like button below. If you have any comments, please do share them below. And of course, if you like this video and want to retweet or share this video with others, please do so. Please stay tuned on how to find us on the internet and sign up at MasterChartsTrading.com. Thanks for watching and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trade alert services. Bye-bye.